All right, we are headed right now into the worst 2 months of the year for the stock market, and the market is sending out some warning signals. The question is, are investors listening to them? Art Hogan is Chief Market Strategist at Wunderlich Securities. Good to see you, Art.
Nice to see you.
What are these warning signals that you see?
Well, it's interesting. So it's hard to really get a clear read in the month of August because obviously we have low participation and low volumes. But the only real volatility we've seen for the entirety of this year has come in the month of August. That's not unusual. We've got about 50 weeks without having a 2% drawdown in the S&P 500, but we've had two 1.5% down weeks. They both happened in August. They both had similar but disparate catalysts. One, increasing tensions in North Korea and the Korean Peninsula. You just touched on that, and the other is the inability for Washington to get anything accomplished on their pro-growth policy agenda. Yeah. So I think there's going to be more of that as we head into September. We've got to raise a debt ceiling. We've got to get a budget passed, and we've got both the White House and Congress shifting to tax reform and tax cuts, and that's going to be a bumpy road. So in a market that's pretty fully valued here, 18 times this year's and 16 times next year's earnings, there's probably a reason to be a bit cautious here. I think that we've got the supportive economic data and fundamentals. Earnings have been good, but we've been on a pretty good run here, and if there's going to be a month where you want to be cautious, September typically is one of those.
Yeah, unfortunately, we know that all too well from prior years. When you're talking to regular people on the street, Art, and you tell them, look, the economy's growing at 3%, they'll probably say to you, oh, it doesn't feel like that because my wages have not gone up. It doesn't feel like we're living in this more healthy economy. But because of a 3% GDP print, we're going to see interest rates likely go up. There's now a 40% chance that we get a hike in December. Are you concerned that increasing the pace of interest rate hikes will kill the stock market rally?
Probably not, and I think one of the things you have to think about in terms of interest rates is we're probably going to get balance sheet normalization first. So we're going to have a meeting in September at the Fed. I think they'll talk more about normalizing that balance sheet, having some of those assets run off, and that process probably starts before we have another interest rate hike. Now, remember we had about a 50% chance 6 weeks ago that the Fed was going to raise rates in December. They may well still. I think that would be a good thing. I think they've got some more work to do. I think the market is okay with that and certainly can price that in. I don't think that's the biggest bump in the road. I think normalizing monetary policy is probably not our biggest impediment. The biggest impediment, I think, is the fact that this market probably would like to see some action on taxes, whether it's tax cuts or tax reform. But to get that corporate tax rate to be something to make us more competitive would probably be the next thing we need to see. And if that doesn't get done, call it in the fourth quarter and gets pushed out to 18, that may be the cause for investors to start getting a little bit more concerned.
Well, the president certainly put the pressure on Congress to do that yesterday. Art Hogan, good to see you. Thank you.
Good to see you.